Hello, in this video, I am going to address the situation where someone has a property that's paid off, free and clear, and they want to put an all-in-one loan on that property. The rules and the guidelines on this are a little bit different, so that's why this warrants its own video. My name's Miles Pitcher. I'm the owner of Superior Lending. I'm an all-in-one expert. We love doing these. We think they're one of the most powerful loan products out there. So let's dive into this. So I want to do a quick recap. If you are new to the all-in-one and haven't watched any of my other videos, I'm going to post a link below for the intro video, but I'll do a quick recap. The all-in-one hits some purposes that we love that makes it, in our opinion, potentially better than a 30-year mortgage. It gives you flexibility. It gives you liquidity for up to 30 years, meaning you can put money in and draw it back out. And we only do these for the clients where it makes sense or it shows a way that they're going to reduce years off their mortgage and or save a ton in mortgage interest paid. Those are the objectives, and that's what this loan product takes care of. I know that that's a lot on this slide, but so what the all-in-one structure is, it is a first position HELOC. And I know that's not a new concept for people, but because this all-in-one has a sweep account, a zero balance sweep account, what that means is as deposits come into your bank account, your checking account, they will automatically sweep over every night and reduce down your HELOC balance. And then as you spend money via check writing, online banking, bill pay, wires, money sweeps back to cover those every single night. We call it a zero balance because at midnight every night, if there's money in the account, it's going to sweep over and pay down your HELOC, so your bank account balance is zero. Or if there's a check that needs to be covered, it'll sweep back from the HELOC and pay that check. And again, your checking account balance will be zero. That's why we call it a zero balance. This is a diagram of the structure of a all-in-one. So this top line represents our credit limit for the first 10 years. And then after year 10, it starts reducing down. And again, this is credit limit. The darker blue here represents an illustration of what a loan balance may look like. You may have lots of deposits coming in, and over the years, you reduce your balance down, and then you have to fund your kids' college tuition. So you draw it back out. Maybe you get paid off to zero, and then you have investment property purchase, dream vacation, whatever pops up. This is how you have the flexibility to control or be your own bank with the all-in-one loan. Once again, I'll just say it so you see this. The top of the graph represents the credit limit. The blue represents loan balance. Again, if this is new to you, please watch the full-length intro video. But let's talk about free and clear properties. So we need to break this into two categories: a primary residence that has or second home that has no mortgage on it, or an investment property. We'll start with the primary residence. And when I say free and clear, it means that there is no mortgage on the property. It's been paid off. And in the guidelines on the all-in-one, we will treat these as cash out refinances. Okay, so primary residence or second home, so you must take an initial draw. Actually, let me back up and mention something on the second home. If you have a second home that you use as like an Airbnb when you're not staying in it, and you show those rental incomes coming in on that second home on your tax returns, the all-in-one is going to treat that property as an investment property. Okay. But if you don't rent it out, you don't collect rents off of it, have income coming in off of it, you can treat it as a second home. Now, when we put the all-in-one in place and on these properties, you must take an initial draw out of there. And we give a range $50,000 to $100,000 because, again, if the credit limit's small, then the initial draw doesn't have to be so big. But if it's a $2 million credit limit, then they're going to be looking for you to take a larger initial draw. The reason for the initial draw has to be documented, meaning you're going to have to write a letter that says, I'm pulling out the money to whatever, put some operating capital in my business, buy some inventory, remodel my kitchen, build an addition on my house. The reason needs to be there. It needs to be a legit reason. So when you close, they're going to hand you that initial draw, and you need to keep that money out and in use for around 6 months before you put it back into your all-in-one. In this situation, they will allow you to go to a credit limit of 70 to 80% of the appraised value. Why is it a range? Because as you get up into the $1 million, $1.5, $2 million loan amounts, the LTV starts coming down on there. So if you're doing a $2 million, doing like a $2 or $3 million credit limit, is going to be around 70% loan to value, or 70% of the appraised value. This is a new guideline that we just had opened up to us. This is huge. On a primary residence, we can now do an all-in-one loan up to $3 million. So that's pretty awesome. Obviously, you have to meet all the guidelines and qualify and have the debt ratios to do it. But we love that we can start bumping up how big these credit limits are. So that's the primary residence second home. Okay. And we're going to talk about the investment property one now. And we'll jump in here. So again, investment property for us in the all-in-one loans can be 1 to 4 units. So if you have a fourplex, it works great. You do have to take the initial draw. You have to have the legitimate reason for the withdrawal. 70% of the appraised value is the maximum for your credit limit. Okay. And that the other piece to it is that the maximum you can do is $500,000. So let me give you a scenario here. You have $1 million property and you have no mortgage on it. And you say, I'm going to do an initial draw of $100,000. Okay. So that's your initial draw. That will be the starting balance. Your starting credit limit is going to be capped at $500,000, even though I know it says right there that there's 70%. So they're going to go off of the lesser of what the max cash out is and the 70% of appraised value. So your credit limit would be $500,000 on there. Okay. But if you were on a lower property, say like a $500,000 appraised property, and on that one, we could do 70% of that, which would be $350,000 credit limit. That would work because it's at or below the $500,000 amount. I hope that helps, and I hope that makes sense in that we have to treat these free and clear properties a little bit different than the situations where we're paying off existing mortgages. Those change the rules a little bit. Let me know if you have questions on this. And I'm always happy to run through scenarios, strategize with clients, and make sure that this is going to be a good decision for them and that it's really going to be financially beneficial. Here's my contact info. You can always text me that number or email my team right there. We love talking to you and helping you out with these. Have a good one. My name's Miles Pitcher.